Welcome to the Bulls, Bears, and the Bell podcast.
Good morning, everyone.
It is Monday, August 17th, 2026. And for today's deep dive, we are unpacking a pre-market financial report that is, honestly, it's just flashing completely conflicting signals right now.
Yeah, the cross currents we're seeing this morning are extreme. I mean, the classic rules of correlation are just breaking down entirely.
Right, like if you take a standard compass and you stand exactly on the magnetic North Pole, the needle doesn't actually point north anymore, it just spins, because the magnetic pole is coming from directly underneath you.
It overwhelms the instrument.
Exactly. And looking at the global financial data we've gathered for you today, that spinning compass is basically the perfect representation of where the markets are at right now.
It really is. We're looking at a global economy that's basically fracturing into two completely distinct realities.
And our mission today is to decode that split-screen economy. We've got high-tech AI infrastructure generating, unprecedented wealth on one side,
While traditional industrial sectors and physical commodities are simultaneously flashing these severe warning signs of a global slowdown on the other.
right. And for you listening, whether you're adjusting your own portfolio or you're just watching prices at the grocery store, understanding this tension is critical because these are the invisible forces dictating the real economy.
Absolutely.
So let's start with the great divergence happening in the U.S. markets right now because the major indices are entirely out of sync.
Yeah, they're rowing in opposite directions.
Completely opposite. So the S&P 500 is basically flat. It's up a marginal 0.1%.
Just digesting the data.
Yeah. And then the Nasdaq 100 is leading the chart higher, up 0.15%, driven purely by this relentless AI infrastructure momentum. But then you look at the Dow Jones.
The old school industrials.
Right. The Dow is actively sinking. It's down 0.1%. Like a twin-engine plane where one engine, the AI and tech side, is roaring at full thrust.
And the other engine is just sputtering out.
Exactly. So with that weak retail print we saw on Friday punishing the industrials, I mean, is this Magnificent Seven tech trade getting too crowded? Or does it actually still have room to run?
Well, so that split between the NASDAQ and the Dow really is the blueprint for everything happening globally today. That cooling retail data from Friday showed a really distinct pullback in consumer spending.
People are just buying less stuff.
Right. And for the industrial manufacturers, the transport companies, the big box retailers that make up the Dow, a slowing consumer translates immediately into downward earnings revisions.
But I have to push back on the market's reaction here. Because historically, if the everyday consumer is tapped out, highly valued tech stocks are usually the first assets to get liquidated, right?
Normally, yes. Investors would dump those high beta growth stocks.
They'd run for cover. So why is Wall Street treating this massive, expensive AI tech trade like it's a safe haven treasury bond?
Because the definition of a safe haven has fundamentally changed. I mean, when traditional consumer sectors look vulnerable, institutional capital doesn't just want to sit in cash. It hunts for visible, secular growth.
It needs a place to park.
Exactly. And Wall Street has decided that the global build-out of AI infrastructure, so data centers, specialized silicon, power grids, that's going to happen regardless of whether the average consumer buys fewer physical goods this quarter.
So the thesis is, Microsoft or Meta will just keep spending billions on servers, even if the broader economy contracts.
Precisely. It's viewed as an arms race. And on top of that, you have to factor in the interest rate mechanics.
The Federal Reserve?
Right. When retail data cools down, the bond market immediately assumes the Fed has room to run with lower interest rates to stimulate the economy.
And lower rates mean cheaper borrowing.
Which is a massive tailwind for tech companies that need billions in capital expenditures to build out this AI infrastructure.
Wow. So bad news for the physical economy literally becomes structural fuel for the digital economy.
It does. But, you're right to ask about the crowding. The concentration risk is immense. You have trillions of dollars tied to the assumption of uninterrupted growth in basically one sector.
Right, if there's even a minor bottleneck.
If the timeline for AI profitability gets pushed back even a few quarters, the capital flight out of those concentrated positions would be violent.
And that anxiety about the underlying health of the economy perfectly explains the total anomaly we're seeing in the commodities market this morning.
The shiny paradox.
Exactly, because if high-tech is booming, you'd expect fear gauges to be pretty quiet. But instead, precious metals are going absolutely to the moon.
The commodities data is where the real anxiety is hiding in plain sight.
Let's run the numbers, because gold is on a historic bull run. It is testing psychological resistance at a staggering $4,395.98.
Knocking on the door of 4,400.
Right. But in a world completely obsessed with cutting-edge AI, the hottest asset stealing the show this morning is a shiny rock from antiquity. Is this just basic panic buying?
No, it's a lot more complex than just a standard flight to safety. This surge to nearly $4,400 is highly calculated macro positioning.
How so?
Institutional investors are using it as a massive inflation hedge against these upcoming promised global tariff structures.
Oh, because tariffs act as a tax on imported goods.
Exactly. If sweeping tariffs are enacted, the companies importing those physical goods will pass those added costs directly onto you, the consumer.
Which artificially reignites inflation, completely independently of whatever the Fed is doing with interest rates.
Right. And the market is staring down the upcoming U.S. inflation report, the PCE, and recognizing that traditional monetary policy might not be enough to contain tariff-driven price spikes. So gold becomes the ultimate insurance policy.
But then the precious metals story gets even weirder when you look at silver.
Silver is fascinating right now.
Yeah. It's sitting at $65.76 today, just experiencing extreme volatility. If gold is moving on macro fears of tariffs, what's driving silver?
Well, silver is caught in this intense microeconomic squeeze. Unlike gold, which is mostly just a store of value, silver is a highly conductive industrial metal.
Right.
And the aggressive rollout of green tech solar panels, advanced EV components, energy grids that requires massive physical quantities of silver.
So you've got intense industrial demand colliding with a finite supply.
And colliding with speculative traders. It creates extreme volatility because the actual manufacturers need the physical metal to keep their assembly lines moving, regardless of the daily price fluctuations driven by Wall Street.
That contrast between the digital euphoria and the physical reality is so sharp, especially when you look at oil this morning.
The energy markets are incredibly telling today.
Right, so WTI is trending lower at $81.85. Brent is at $88.27.
It's probably the most sobering data point in this entire report.
Because it completely defies the geopolitical landscape. We have severe, ongoing tensions in the Strait of Hormuz. Traditionally, any threat to that shipping lane causes a massive spike in oil prices.
Because of the fear of a supply shock.
Right. So why are prices dropping?
Because the market is significantly more terrified of a global growth slowdown.
Demand destruction.
Exactly. If the global industrial base is slowing down, if factories are producing less, and ships are moving fewer goods, the world simply requires less physical energy.
So the declining demand totally overrides the geopolitical risk premium.
It completely corroborates the weakness we saw in the Dow Jones. The physical machinery of the global economy is tapping the brakes.
Wow. Okay, so we've established this split screen in the U.S., but this AI boom isn't just an American phenomenon. It is completely rewriting the narrative across Asia.
The structural shift in the Asian markets is historic.
Let's look at Japan. The Nikkei 225 closed at 69,220.25.
Up 0.7%.
Nearly double from just a few years ago. And with a 1.1% GDP growth rate, Japan has achieved a soft landing for the yen.
The lost decades are officially a distant memory.
They really are. And then South Korea, their markets are closed for a holiday today, but the Kospi is up over 100% year to date.
Heavily driven by the semiconductor giants.
Right, Samsung and SK Hynix. But this is what I want to ask you about. We can easily understand NVDA driving the S&P 500 here at home, right? Analysts are watching for follow-through after massive 10-for-1 splits over the past 2 years.
Right. NVIDIA is the quarter pole for the broader market.
But how exactly is AI hardware demand single-handedly pulling entire foreign emerging markets and even domestic small-cap stocks into the stratosphere?
Well, for Asia, it comes down to the supply chain. An AI chip designed in California is useless without highly specialized memory to feed it data. High bandwidth memory, or HBM.
And South Korea controls that.
Yes. Samsung and SK Hynix dominate global HBM production. They act as the bottleneck for the entire global AI rollout. So when emerging market funds rebalance, they're forced to pour billions into South Korea just to maintain their required exposure.
But what about the small caps? Because the pre-market movers we're seeing today are wild.
This is where the liquidity trickle-down effect happens.
We've got Faraday Future ticker FFIE surging 81%, Dyne Therapeutics DYN up 27% on clinical trials, And multi-metaverse, MMV, rocketing 118%.
Right, and that is not driven by fundamental valuations.
No, obviously not. So how does the top of the market being flush with cash cause a metaverse penny stock to jump over 100% before the sun even comes up?
It's excess capital aggressively hunting for explosive growth. Imagine a fund manager or a retail trader who just secured massive profits from the mega-cap tech rally.
They've got cash burning a hole in their pocket.
Exactly. And they want the kind of asymmetric growth that a mature, multi-trillion-dollar company just can't provide anymore.
So they take their winnings from the main casino floor and walk over to the high-stakes tables.
That's the perfect way to put it.
Yeah.
They deploy a fraction of those profits into highly volatile, low-liquidity sectors like biotech or speculative EV concepts. And because those small caps have so few shares available to trade, even a small influx of capital causes these violent triple-digit swings.
So it's basically a euphoric symptom of a market starved for new frontiers.
Exactly.
Okay, so we've mapped out the roaring tech engine in the US and the incredible wealth generation in Asia, which logically brings us to the glaring exception on the global map.
The old world.
Europe is currently being left behind entirely.
It's a stark contrast.
The numbers are rough. Germany's DAX is flat at 26,429.59. France's CAC 40 is down 0.1%. The UK's FTSE 100 managed a meager 0.2% gain to 10,773.91.
They are completely missing out on the rally.
It's like the European bourses are a ship anchored down by incredibly heavy cargo, high energy costs, old world trade dynamics, and they're just watching helplessly as the US and Asian speedboats race past them on this AI wave.
That analogy is spot on. Europe is facing severe structural disadvantages right now.
What's the core issue? Just energy.
Energy is a huge part of it.
Yeah.
Following the geopolitical shifts of the last few years, they lack access to cheap energy. But more importantly, they lack a dominant domestic tech infrastructure sector to offset the pain in traditional manufacturing.
So they don't have their own Magnificent Seven?
No, they don't have an equivalent to Microsoft or NVIDIA or SK Hynix. So Europe is bearing the absolute full brunt of the global industrial slowdown.
Which is foreshadowed by the dropping oil prices and the struggling U.S. Dow Jones we talked about earlier.
Exactly. Without a digital safe haven, their indices remain completely tethered to the old world physical economy.
All right, let's recap the essential takeaways for you listening today. We are unequivocally living in a split-screen economy.
Without a doubt.
The AI and tech sector is driving historic highs in the Nasdaq, in Japan, and Korea. Meanwhile, traditional industrial metrics and plunging oil prices are suggesting a slowing global engine.
And meanwhile, gold at nearly $4,400 is serving as your ultimate insurance policy against looming tariff and inflation uncertainties.
Right. And whether you are adjusting your own portfolio or trying to understand the next Fed move, these macro forces are the invisible hands shaping the daily economy.
They're rewriting the rules in real time.
They really are. But I want to leave you with a final, provocative thought to ponder long after this deep dive ends.
Let's hear it.
If the massive global build-out of AI infrastructure is the only engine currently keeping the world's markets afloat right now, what happens to the global economy on the day that infrastructure is finally built?
Well, that is the multi-trillion-dollar question.
It really is. Thank you so much for listening to the Bulls, Bears, and the Bell podcast.
Make sure you subscribe on Spotify or your favorite podcast app so you never miss an update.
We will see you next time.